If you're considering a debt consolidation loan with Happy Money, then this video is for you. Happy Money offers debt consolidation loans from $5,000 to $40,000. They call it the Payoff Loan. Now that's a clever bit of marketing. In this video, I'm going to tell you more about Happy Money and give you the information you need to decide if a Happy Money Payoff Loan is a good decision for you. Who is Happy Money? Let's start with the complicated part. Happy Money is not actually a lender. They're a financial services platform. They use this platform to connect credit unions and other lenders with people in need of a debt consolidation loan. They say they are customer-focused and customer-centric, and they pride themselves on being transparent. And overall, this looks to be true. They provide more details about their lending processes than any lender I've seen in the last 10 years, and that impresses me. Happy Money connects credit unions to people like us who need a little boost in getting out from under credit card debt. They work with several credit unions, including credit unions like Alliant, Blue Federal Credit Union, and Teachers Federal Credit Union. But they also work with smaller credit unions and other community-focused lenders. This is important. Because the loans are made by credit unions, they have to follow credit union requirements, including a lower maximum interest rate than most other financial institutions. And I'll talk more about that later. How much can I borrow from Happy Money? Happy Money offers debt consolidation loans between $5,000 and $40,000. Now, $5,000 is a lot of money, but it's really the minimum most people need to make a debt consolidation loan a worthwhile effort. The loan terms range from 2 years to 5 years, which is good for loans of this size. But I wouldn't recommend taking 5 years to repay a $5,000 loan. And you should really be careful signing up for 2 years on a $40,000 loan because the monthly payments could really stress your budget. Here's a tip for any loan you're considering. Sometimes it's best to sign up for a slightly longer term with a monthly payment that's lower than your budget allows. Then, plan for and pay extra on your loan each month. This way, you pay off the debt as fast as possible while preserving your financial flexibility. Having that flexibility in your budget can really be helpful if unexpected expenses come up. You just need to make sure that there isn't a prepayment penalty on your loan. How much does a Happy Money debt consolidation loan cost? Happy Money loans will consist of an origination fee and interest. Those combine for the total cost on the loan in an APR. Let's start by looking at the origination fee for their loans. Happy Money charges an origination fee of 0 to 5%. The origination fee will vary by the size of the loan, so you will probably see the percentage rate change if you change the loan amount. Typically, the origination fee percentage will be highest on the smallest loan amounts. Here's a couple of examples. If you opt for a $5,000 loan, you can probably expect an origination fee of 5%. That means you'll receive $4,750 in your bank account or paid directly to your credit cards. The remaining $250 is the fee, and it's kept as payment. You will have to pay back the $5,000 plus interest. Now, if you decide on a $10,000 loan, the origination fee will probably be a little lower, say 4%. So you would receive $9,600 in your bank or paid directly to your credit cards. The $400 fee is their payment, and then you would repay the full $10,000. Now, one thing I like about Happy Money and their lenders is that they do not charge any other fees on their loans. No late fees, no NSF fees, no check processing fees, and most importantly, no prepayment fees. It means they're doing their best to be transparent and fair, making it easy for you to repay and not penalizing any missteps. The interest rate on a Happy Money loan isn't advertised on its own, but the total APR will range from 11.75% all the way up to 24.81%. Now, this upper limit on the interest rate is lower than most lenders, and that's because they work with credit unions and not banks. But the minimum APR is slightly higher than most. That tells me that people with excellent credit, those above a FICO score of 760, can probably find a lower rate by shopping around. But from 640 up to 760, they may be a great place to get a loan. Who can get a Happy Money debt consolidation loan? I'll start with the application process first. First, Happy Money uses a soft credit check system, so applying will not impact your credit score. They will issue a hard inquiry if you take the loan. This means that checking for approval with them if you're shopping around is a good idea. As to who can get approved, Happy Money is much more transparent about this than most. Before I get into the details, let me start by saying that these are the minimum requirements. Meeting them does not guarantee that you will be approved. Happy Money requires a minimum FICO credit score of 640. They also require no delinquencies on credit accounts. This means all of your accounts must currently be in good standing. Having a missed payment in the past does not prevent you from getting a loan with them. But if you're currently past due, you will need to bring the account or accounts current and then wait for that to be reflected in your credit report before applying. They also look at other core credit factors, such as age of credit history, your credit card utilization rates, and your payment history on all of your open accounts. Your debt to income ratio will also be reviewed. They're going to compare your current debt to your income and determine if you will be able to make the loan payments. Will a Happy Money debt consolidation loan really improve my credit score by 40 points? This is a nice statement that Happy Money shares, and it's possible that taking the loan and consolidating your debts will improve your credit score. Here's the details. The 40 points is an average based on customers who took a loan with them during a few months in 2021. Credit scoring hasn't changed since then, so this average is still relevant. But this improvement isn't unique to Happy Money. It's true for any debt consolidation loan. It happens because the loan creates a large drop in credit card utilization, which is a large factor in your credit score. So don't choose Happy Money based solely on this fact. When is a debt consolidation loan a good idea? Credit card and debt consolidation loans can be a great help in the right circumstances, but when used wrongly, they can make the problem worse. Here's what you need to do before you take a debt consolidation loan. First, you need to consider your overall financial situation. Do you have a budget or money management plan in place to ensure that you can pay all of your monthly expenses plus the loan payment without adding any new credit card debt? This is important because a lot of people fall into this trap. They clear up the credit cards with a loan, but then add new debt back to the cards. This just leaves you with double the debt, so you have to be careful. Second, consider carefully the debt you want to consolidate. It's often best to exclude debts with low interest and those with less than 1 year remaining until they're paid off. You don't want to increase your interest burden. You also don't want to add years to a debt you've almost paid off. Lastly, you need to figure out how much you need and then don't borrow any more. There's a couple of factors to consider here. Let me give you an example. Suppose you have 3 debts you want to consolidate: a $4,000 credit card with 29% interest, a $5,000 credit card with 24% interest, and a $6,000 credit card with 19% interest. Now there's a total of $15,000 in credit card debt, but the interest rates vary. Now, suppose you're offered $20,000 at a 14% interest rate. The interest rate is lower than all of your debts, but don't take the $20,000. That's $5,000 more than you need and $5,000 extra debt to pay off. Only accept the $15,000 you need. Now, what if you're offered $15,000 but at a 20% interest? Well, don't take $15,000. That would mean you're paying an extra 1% interest on the $6,000 in credit card debt. Take $9,000 instead at 20%, pay off the higher cards with the loan, and continue paying the 19% credit card directly. Is Happy Money a good company? Personally, I think Happy Money is a good lending platform. They have the right things in place to help people get out of debt. While I will always recommend applying with at least 3 lenders using soft credit pools. At the Yukon Project, we've made this simple for you by bringing over 40 lenders into our platform. All you need to do is head over to our marketplace and apply once. The link is in the description. Then our 40+ lenders will review your application with no impact to your credit score and send back their best offers for you. Then you can compare the offers, choose the one best suited for your needs, and rest easy knowing you got the best loan available. Happy Money is definitely one I would put on the list. Thanks for watching our video. If you found it helpful, please support our effort by hitting the like button and subscribing to our channel. And if you've had a personal experience with Happy Money, please tell others about it in the comments below and help them with your experience.